Roger Kowalski, a director at iGlobal. It's great to be hosting today's live virtual experience. ESG and independent sponsors, are you behind the eight ball? Anecdotally, coming out of the shutdowns in most cities and the fallout from the pandemic, someone's calling me at the wrong time. Companies are, that are being purchased with an independent sponsor and a capital provider involved. We're seeing far more consciousness around ESG and DEI. It's simply just what's happening. From a real estate perspective, owners and operators, developers that might be repurposing an old asset or building a new project, it's simply part of the equation most of the time. And you need to understand the importance of ESG and how to report it and communicate it, or you simply might not be where you need to be as a sponsor, and hence the name of today's webinar. So we've assembled an incredible panel of practitioners from a few different industries. Some very quick housekeeping. You might have seen a slide while you were waiting for the webinar to begin about the ISCP Club. If you're not a member, you really should be. It's an online community solely dedicated to independent sponsors and capital providers where you can find deal partners, expand your network 24/7, 365 days of the year. There's a search function that's being used all the time. We host live, video interviews, send out a monthly newsletter on independent sponsor related information. If you join at the premium level, you get access to all of our in-person conferences as a part of the annual kind of registration price. So please email me about that if you want to see how it works. It's really very exciting. We have like 700 something members right now. Number two is this panel is going to allow for you, the attendee, to submit questions in real time. If you move your mouse, you could see a box pop up on the bottom. One of the options will say Q&A, so you could type in questions. Please send good questions, but we're holding off answering questions. We have a lot of content here. We're going to hold off towards the end of the session with about 50 minutes in, so 10 minutes left. We'll tee up some of the questions to the panel. So on to the content. Elena Mervine is a managing director in the transaction advisory services section within CohnReznick. Elena, how are you?
Good. How are you?
Quite all right. Thank you for doing this. Very important topic. I love working with CohnReznick. I'm handing it over to you. Please allow our panel to quickly introduce themselves. I'll go off camera and you'll see me again, for a 10-minute warning at 12:50.
Great. Thank you, Roger. And I wanted to thank everyone who's joining us today. So a little bit about myself. CohnReznick is one of the top national accounting, tax, and advisory firms in the United States. The group that I reside within is Transaction Advisory, and we're the group that performs due diligence on transactions for buyers and sellers. We work on approximately 600 to 700 transactions per year, almost 50-50 split between buy-side and sell-side due diligence, and we work on behalf of strategic and financial clients, including private equity firms, family offices, lenders, and independent sponsors. So we have an incredible panel today, and the panel will weigh in on the issues around ESG, environmental, social, and governance, especially as it applies to independent sponsor community. Over past 10 years, or over the past decade, private equity firms, institutional, and other investor groups have increasingly acknowledged the importance of ESG. Some have adopted it as a risk management strategy. Some are trying to stay abreast of the ever-evolving regulatory environment, and others are driven by value creation and improvement of performance of ESG-focused funds. And for many of us, this is just the right thing to do. So what does it mean for independent sponsors? Are they behind the eight ball? Before we dive into that, I would like our panelists to self-introduce. Maybe Doug, maybe we start with you.
Sure, happy to. Doug Song, Protos Capital. We're an independent sponsor firm. We have been around since 2003, so 20 years this year. And we focus on lower middle market investments in industrial, business services, distribution, and consumer end markets, primarily focused on entrepreneur-owned led businesses, majority recaps for those businesses. We have definitely been thinking more and more about ESG, which we'll get into on a thematic standpoint. We'll get more into that as we go, but I'll yield the floor to the next panelist.
Okay. Alicia?
Thanks so much, Elena. Hi, everybody. Alicia Hill. I'm with FCP. I'm a vice president of impact investments there. FCP, we're a real estate investment company and a multifamily owner operator of around 20,000 multifamily units nationwide. We also do quite a bit of work on the development side as well. And over the last 5 or so years, we have really done quite a bit of work to advance our efforts as a firm around ESG, in particular within the real estate space, just given the intersection between ESG related matters and the built environment specifically, and then also given that we're working in a number of different communities nationwide. By way of background, I've done a lot of my work in the community development finance space and within affordable housing as well, focusing on impact investing more broadly and specifically the variety of intersections with our stakeholders, whether that be the investor community, partners that we may work with, and then also certainly with other peers in the industry.
Great. Kevin, would you like to go next?
Absolutely. Thanks, Elena. Kevin Barner here, founder of Anchor Point Partners. We're an independent sponsor firm focused primarily on the building and construction space and operating companies within that sector. Before founding Anchor Point, I was a partner at Lone Star Funds. It's a multi-billion-dollar global PE firm. And started my career in private equity, which is a field that I've been in for the past 17 years, at a middle market and lower middle market firm called the Halifax Group. So have kind of had a barbelled approach to my career, working with very large, sophisticated companies at Lone Star, which has been a great template to really see corporate best practices and how things like ESG have been integrated into larger organizations, and really starting my career with smaller organizations that had a little bit more opportunity for improvement, such as, being more mindful about how to implement ESG on a sustainable basis. From a governance standpoint, I've been on 11 boards throughout my career, several of which were for publicly traded companies, and have seen how ESG has become a bigger and bigger part of the dialogue in the boardroom. And I think what's exciting about what we're going to talk about today is how can we make it a bigger part of the dialogue for the types of companies that independent sponsors invest in.
Great. Heidi? I think you're on mute.
Apologies. My name is Heidi Van Ham. I'm a managing director at Broad Sky Partners. We are a private equity firm focused on U.S. middle market companies, mainly in the business services and consumer sectors. I've been in private equity for the past 15 years, just like Kevin, kind of, going across the gamut. Prior to Broad Sky, I was at Carlyle for 5 years, and prior to that, I worked at InvestCorp. Broad Sky Partners was established in 2021, so we're a relatively new firm, and I manage the day-to-day operations, building out the platform and institutionalizing the business, set it up for, future growth. And when we started, we didn't really have the internal expertise on ESG, but it is important to us and to the entire community. So from the get-go, we teamed up with specialty consultants, and we have a very well respected industry resource who sits on our executive board. And with their help, we've developed an ESG program, which I'm sure will continue to evolve over time, but I'm just happy to share our experiences to date, how ESG is embedded in our investment process, and how we engage on this topic with our portfolio companies.
Great. And Andre?
Hi, everyone. My name is Andre Oldacre with AOR Development. We focus on acquisitions and new construction in the New York City area. I've 16 years as an owner-operator of multifamily within New York City, but we started our firm in 2019. At our core, we're sustainable developers. We look to do 100% electrification and get closer to carbon neutral for all of our buildings, whether it be acquisition or new construction. We're very big believers in modular construction and some newer building techniques to lower operating costs. So I wear a couple of the hats in the ESG space. I'm chair of the Offsite Construction Council with the National Institute of Building Sciences. We're advocates for prefab and offsite construction, and modular construction throughout the industry for the U.S. market. Right now, the U.S. is only 4 to 5% modular construction, but in other countries across the world, like UK is 10%, Japan is 15%, and in Sweden and the Scandinavian area, they're 85%. They've actually taken a lot of what we've learned and built and run with it as they continue on with it. I'm also on the board for New York State PACE, which is Property Assessed Clean Energy, to help address climate concerns that we have here. And New York City in particular has very, very strong goals with the local law 97, which we'll talk about later as well. So
great. What an incredible panel today. So now I would like to ask each panelist as to the role ESG plays in your decision making. So how much ESG factor into your or your firm's investment decisions? Who would like to start? Doug?
Sure, I be happy to. So we do incorporate ESG in the following way. I mentioned this in my introductory comments. We're looking at ESG sort of from a deal selection standpoint. First of all, if we have two deals and one is ESG and the other is non-ESG, we're most likely go towards the ESG for the obvious reasons, right? Elena, you mentioned it earlier. It just feels better to do that deal versus the other. So we certainly have a selection process that way, but further to that, we've come up with a series of themes, and these are themes that we want to focus on, and these themes have an ESG element to it. And I'll describe some of these themes, which hopefully resonate with some of the other panelists. One of the themes is affordable housing, low-income housing, right? So we're looking at contracting businesses that focuses on that sector. So we have an executive that has done work in that sector, and we're looking to create a platform in that sector to focus on affordable housing and low income. And I think there is a need in this country, and it's going to continue to be a need in this country. So I see this not only as a good, ESG component to it, but also there's a demand component to it, right? So that is one of the themes we're pursuing. Another is clean water conservancy. As you all know, water is a scarce resource, especially in the emerging countries. And so we're looking at technologies and other service businesses that focus on that sector. And that, I think, has ESG elements to it as well. Anything around conservancy, I think, has an ESG element. I'll just give one more example. We have probably half a dozen themes we're pursuing. Another is energy efficiency. And I'll give you a live example, and Andre kind of touched on this, but we just closed a transaction. It's a commercial HVAC reseller. And the reason we like that deal is there's an ESG element to it, which is the business is all about energy efficiency, meeting new energy efficiency codes that are mandated from the federal level on down, as you're very familiar, Andre, I'm sure.
Of course.
And also the electrification trends. So there's a definite ESG element to it, but it's also the driving engine behind the company because of the demand that's coming from the electrification and energy efficiency codes that are mandated by 2030. All new construction and all existing buildings have to meet these codes. So there's huge demand as a result. So this company has doubled its revenue from the previous year. And we have something like a $70 million backlog and several $100 million of pipeline. So this is going to be something that's going to continue. So not only is it an ESG element to it, but it's also what's fueling the growth and the value added and the value creation here. So it's very thematic what we're pursuing in terms of ESG.
Great. Alicia?
Yeah, I think just to piggyback on that a bit, in terms of how it factors into our approach, it really broadly gives us a framework through which to really look at characteristics that tie to risks. And so, when you're making that evaluation of an investment opportunity, particularly in the real estate space where there's a significant amount of opacity to some of the market information and that you have about an opportunity, it allows us to really evaluate our underwriting along measures that broadly fit in those buckets. So just for a granular example, if we're looking at an opportunity where it's in a location that's facing disproportionate risk with respect to climate change, are we effectively accounting for that with respect to the duration that we might want to hold an opportunity like that? So I think broadly for us, we have a sort of a checklist that we go through that allows us to identify the measures that are meaningful for our specific asset class and investment area, and really allows us to have a comprehensive set of information so that we can make sure we're making the most effective decision. And I think, in addition to having a commitment as a firm and wanting to do the right thing, to Doug's point, and specifically, I'll speak on the affordable housing space, a lot of these areas that roll up into either the E or the S of ESG also are directly tied to the underlying fundamentals of that opportunity. The demand for affordable housing is significant. The supply that's available is de minimis in comparison. And so to be able to codify what we understand as practitioners, the level of demand along actual measurable indicators that also translate to a stickier resident, which means a highly occupied property, which means ultimately a sound investment, even if you're not considering, sort of the social impact factors, it allows us to really have a framework where we can talk about that around the table before pursuing an investment, and certainly provide that to investors and our stakeholders to understand why the opportunity makes sense. So I would really say it's really intended to provide more effective decision making and really help identify any non-starters or make sure that we're mitigating the risks that we identify effectively going forward.
Great, Kevin.
Yeah, so I think about all investment decisions is really starting from deal flow. So, I'll talk a little bit just about deal flow. And when you're an independent sponsor, or if you're at a large fund, your deal flow is a mix of inbound, reacting to what's put in front of you, and outbound origination. Oftentimes that's thematic driven. And I think everyone on this panel has various themes that we like to focus on. The reality is it's not always linear. It's a little just, a mix of both those reactive and proactive measures. When I'm sifting through what's coming into deal flow, one of the realities of being an independent sponsor is you are resource constrained. So obviously you have to look at what the economics of the deal are, and is it meritorious for investment? But another big screen for me, at least, is can I actually transact with this business? Who's pursuing this business? And that's where I think differentiation and a specialization can come into play and really serve as an angle here. Mine being building and construction, having spent a long time there, I've been able to develop a level of credibility and dialogue with the type of founder, owner, entrepreneur-led businesses that I'm looking to invest in within the space of building and construction. And what I've seen, and this kind of touches on your point, Andre, building and construction in the US is an industry that has been slow to evolve, but there are so many things you can do, particularly from an environmental sustainability and efficiency standpoint within the process to speed construction or modularize elements of construction that I've been leaning into in terms of my deal flow. And again, back to, you kind of have to pick your spots as an independent sponsor. It's opened up an opportunity, just given some of the headwinds in the economy right now. Building construction is kind of out of favor. So I've been able to be a little bit more selective in terms of what I pursue. And to Doug's point, if I see a ESG component to a business and the ability to really lever that as a value driver and as a means to take share, then I'm going to lean in. So I think it's something that can be a real differentiator here, and juice the economics, because we're all economically motivated at the end of the day, but it can really be a way to accelerate those and take share. And I'm seeing that. I'm working on a deal in modular construction right now, actually, where I'm seeing them take share. And so it's kind of energizing to see that business do well while also doing a greater good. So that's the home run in my book.
Yeah, so we do both, like I said, both new construction and acquisition. We've kind of focused more on the acquisition side because we're seeing deals, specifically within New York City, where we can assume debt, and in this high interest rate environment, it makes new construction a little bit harder to pencil out. So we've been leaning more into the retrofits projects, but within those projects, we sift through what we're seeing in the deal flow, and we'll look at projects that we know we can do 100% electrification of the buildings, going from the gas or oil boiler system into high efficiency heat pump system. We'll look to seal the building envelope. Also ABC came up with a study that said that 48% of your building loss is from your windows. So we look long and hard at the windows of the building and look to either secure it with either remove them and go to triple pane, or some other techniques to reduce the loss from the windows. We also look to add geothermal, solar, battery storage, water filtration systems. Even within the water system, we look at smart valves to reduce most people don't realize 20% of what you're being billed for in your water is actually air being pushed through the system. And there's smart valves that will allow you to basically remove all that air and save 20%. So it's a small ROI. We look at all energy efficiencies and upgrades that with an ROI of less than 5 years. That's our investment strategy, between 5 and 10 years. And we're seeing 20% loss, 20 to even 40% decrease in the utility costs. And that sometimes equates to incentives from the utility companies. So here in New York, it's National Grid and Con Ed, but also from NYSERDA, which is the energy authority for New York. And then the Inflation Reduction Act has the 45D and 175L that gives you tax credits as well. So, and then there are also tax abatements for solar here in New York City. So there's all sorts of incentives and rebates that allow you to get up to pay for 50% of your upgrades, and every dollar you decrease from your NOI, it's 20. With a 5 cap rate, that's $20 more in evaluation in your building. So if you decrease your value, you decrease your NOI by 100,000, you're increasing your building substantially. So that's basically been our strategy for acquisitions, but we do a lot of the same in new construction as well.
Great. And Heidi, can you speak about Broad Sky?
Yeah, so for us, I'll talk a little bit about kind of like how ESG is factored into our decision making when we look at new deals. When pre-LOI, the deal teams, they fill out. We kind of developed an ESG screening checklist, we call it. It has, a uniform set of big focus areas that is assessed for each potential investment that we look at, and then it drills down into slightly different considerations, based on the two broad sectors that we're focused on. And the checklists are guided by the SASB materiality framework and include topics like environmental footprint, labor practices, DEI, data privacy, supply chain. And then as we drill down into each opportunity, each sector has slightly different considerations. Some may be applicable for consumer, but not for business services. For example, supply chain is very top of mind for us. On the consumer side, we look at things like, does a company have protocols in place for ethical and sustainable sourcing of their products? Does a company source from countries known to have child labor? So it's a checklist that we go through, desktop work, but it sets the stage for what we potentially need to focus on if we decide to pursue an opportunity. And then once we have exclusivity, we do a more fulsome analysis, and we've closed on 3 deals to date. And on all 3 deals, we've engaged ESG consultants during our diligence process as part of one of the diligence work streams. In fact, our second investment is actually a sustainable casual lifestyle D2C apparel brand, and now is a certified B corporation, but at the time of our diligence, the company was still going through that approval process. So in that instance, we actually had two diligence, ESG diligence work streams. One was just general ESG, and the other one was focused specifically on supply chain visibility and traceability into what the fabric of the clothing was made up of. So obviously, you know, the checklist and the executive summary of the high-level findings from you know, the in-depth diligence work is part of investment committee meeting discussions, and you know, plays an important role in how we decide whether to make an investment or not.
Great, thank you so much. And Heidi, I just wanted to ask you for them, get a glimpse into what happens post-investment. We talk a lot about investment assessment and the checklist and just kind of making that decision, but ESG, you know, implementing ESG framework doesn't end there, right? So
Right.
Do you target specific ESG factors and set of KPIs for each portfolio company, and how do you track and measure that post-investment?
Right. So we actively engage with our portfolio companies. First of all, we share the high-level diligence work and the findings from the pre-close diligence work that we've done with the management team. And then we, you know, early on in the investment period, we offer an onboarding session with the management team to establish, you know, ESG focus areas for the business. What are they interested in? Do they have an ESG policy? If not, do they want help drafting one? We as a firm at Broadsky, we also offer learning sessions for our team on ESG specific topics. Like we have one coming up next week on health and safety, and we invite our portfolio companies to join those sessions. And so, you know, another valuable thing to just keep ESG top of mind, not just for us, but for the portfolio companies. And then in terms of metrics and monitoring, we've developed a framework, a scorecard, so to keep, that we ask every portfolio company to fill out on a semi-annual basis. These reporting templates, they're created in alignment with the ESG metrics outlined in the ESG Data Convergence Initiative. And it's split up into two sections. One is focused on just portfolio-wide ESG metrics, which kind of are the same for all portfolio companies. And then we have company-specific KPIs that we track. So the overall portfolio metrics include composition of the workforce, energy management, resource efficiency, and then company-specific KPIs, you know, depends on, you know, what type of company we're looking at. Examples could be related to product recalls or the number of hazardous inspections, you know, just company-specific KPIs that we develop in, you know, with our ESG consultants. And through this program, we want to, one, establish a baseline at acquisition when we buy these companies, and then on a semi-annual basis, just track and monitor performance over time to quantify the impact of ESG benefits amongst our portfolio, and be able to report that and you know, share that with our investors. I think just to give you an example, one takeaway from the first round of metrics that we completed at one of our investments was to perform a carbon footprint assessment and energy performance analysis for the company. And the process will kick off in February, and we'll focus on calculating scope 1 and scope 2 emissions for the calendar year of 2022, benchmark that against industry averages, and come up with recommendations on how to reduce their carbon footprint. So again, we're early in the process as we're a young firm, and our investments are a year to less than a year old. So this is, you know, very new to us, but this is what we're focused on. And you know, we're lucky to be able to do this from the get-go and be able to track progress. So I can't report on progress yet, but we're off to a good start, I think.
Well, thank you so much. I think that's very helpful for our audience as well, who's still wrapping their head around, implementation and tracking and measurement. There's no one set approach and one set framework, right? So anything, any ideas and that you share and your thoughts, it's very helpful. So now I would like to ask you on the timeline of the more robust integration of ESG into investment framework. Is there an urgency for independent sponsors to take an more active role in ESG implementation?
I can start with that. So for us, it's yes, right now. Like I mentioned earlier, Local Law 97 in New York City has been enacted, and it states that 40% of your carbon emission needs to be reduced by the year 2030 and by 80% by the year 2050. But also, a lot of people don't even realize that in 2024, you have to start reporting your carbon emissions, and you can get fined. You can get fined $268 per ton that you're over starting 2024. So, and that's for any building over 25,000 square feet. And there have been estimates from NYSERDA that say 40,000 buildings will be out of compliance. So for us, it's an opportunity, right? That's what we do. It's the core of our business. There's so many that are going to start paying these fines and be left holding the bag and understand that they have to start making these changes right away. Cities like Washington, D.C. and St. Louis have also enacted similar programs to Local Law 97. And in the next 5 years, I venture to say, especially some of the California cities, this will be all over the country. So it's something that is of most urgency, and applaud New York City for getting started with the forcing owners to do that. But that's kind of where PACE comes in. So PACE allows you to finance 100% of the upgrades for the energy efficiency. New York City kind of approved both at the same time, and that's on purpose. So, the PACE also kind of acts as an energy improvement, but it also allows you to increase your leverage and basically remove the mezzanine financing that would otherwise be 12 to 15%. You can get PACE financing at half that rate, right? From anywhere from around 7% at this point. But more importantly, it allows you to do the energy improvements you needed to stay in compliance with Local Law 97, and also improve the quality of your building. It allows you, a lot of these pre-war buildings in New York City, they only have heating, right? And sometimes the pipes bang on the radiators, and the heat, it might be too hot, so people are opening their windows, so it's not the right temperature. They also don't have air conditioning. With these high efficiency heat pump systems, they have their own in-unit temperature control, and they can put the temperature that they want. It also moves the cost of, the largest utility bill you have in a building is the gas, right? We completely remove the gas bill because we go 100% electrification of the building. That also, because we put the in-units, that transfers the cost to the tenants, but we subsidize the tenants so they're not burdened by a heavy utility bill with solar and battery storage, and we'll subsidize it so that their bill is not increasing exponentially. So they now have a much better building, a much more comfortable environment, and are able to control their temperature. So.
Great. Doug, what about you? Can you comment on the independent sponsor timeline, and do you feel any kind of pressure and urgency?
Yeah, I'll answer that question a few ways. First is, I don't think the independent sponsor community is alone in this. I think if you look at the whole investment environment, market, private equity, everybody, I think we're all in the same boat. And we're all trying to figure this out, right? Because, and I think personally, one of the issues with ESG, we all are conscious of it. We all want to do the right things. we all want to benefit from it, make money, etc. But I think until we have a way to really measure ESG that's standardized, that's acceptable and standardized, I think it's going to be just this nebulous thing, right? And I think because of that, everybody's behind the 8 ball. It's not just independent sponsors. So I want to make that comment. The second comment is, in terms of being behind the curve, we're not going to go zero emissions by 2025. That's not going to happen, right? There's no possible way that's going to happen. I'm not going to go to Davos and say you've robbed my children of their childhood, because that's just not the case. It's going to take a lot of effort, a lot of new technology and time to transition this properly. Now, I think as sponsors, as independent sponsors, we need to embrace that and figure out what are the businesses, the services, the technologies that are going to fill that gap, right, to get to that end goal. And I think that's really where the attention should be, personally, from an investment standpoint. The third point I will make is, as an independent sponsor or as a GP, for that matter, we're seeing more and more of our LPs kind of demanding ESG, right? So this is not just driven by what we want to do as, in terms of our investment strategy, feel good about it, etc. It's really being driven by the LPs. And, you won't see an institutional LP questionnaire that doesn't have an ESG component to it. You just won't, not today. And also what's quite interesting is, as more of the Generation Y, goes into the seats of power, and with the wealth transfer that's occurring, everybody from the family office up to the institutional realm, as you see the Generation Y take more control, I think they are very focused on ESG. So I think that is only going to increase in time with the LP base. So that's how I would answer those questions.
Right. And Kevin, do you have anything to add to that?
Yeah, so I would chime in. Obviously we share the bond of being independent sponsors, and back to deal flow and where we can be effective. It tends to be companies that are smaller, founder, owner, entrepreneur-led businesses, family-owned businesses, and this is from the perspective of an operating company investor. And the good news, bad news about those types of situations is they tend to not be as far along in their, evolution as an enterprise. And the good news is that creates all sorts of low-hanging fruit on ways to add value. You can augment the management team, you can institutionalize their level of reporting, and while you're under the hood, there's plenty of room to talk about how do we put a bigger ESG emphasis into the business as well, tying that into the broader value creation plan that you outline, at the front end of forming that partnership with that seller and that management team. And so, back to the 8 ball analogy, we are, to Doug's point, I think everyone's got some component of being behind the 8 ball here, but we have the benefit of being early on in the maturation cycle of a business, where we can actually start to instill that into the culture more and more and more. So maybe we're closest to the 8 ball, or we can push it the furthest, running with that analogy a little bit. And so that's part of the fun about being an independent sponsor is you can really make a bigger impact, and in a lot of ways help to set the agenda and the culture for these businesses as they continue to mature and institutionalize and integrate a lot of those corporate best practices.
Thank you, Kevin. That's a great transition to my next question, and I wanted to ask Alicia on the originally wanting to ask about the resources being leveraged by independent sponsors, programs, frameworks, scorecards, and I know Heidi already touched upon that, but more broadly, looking at it more broadly, what role independent sponsors can play in addressing the growing demand from LPs, like Doug mentioned, to see the integration of the ESG measures into the investment framework?
Yeah, I think it's a great question. And, sort of leaning into the prior comments, we're all from our various perches, whether you're an LP, a GP, independent sponsor, actively trying to solve for this at the same time. And we don't have consensus around one framework and one approach. And I think, rightfully so, given that there is a certain level of customization. I know Heidi commented around some of the tools that her team uses. And I would say that's a consistent trend that I have seen. And also certainly within FCP, we have adopted a similar approach where I think the role of an independent sponsor or GP is that you really have the opportunity to exert influence with regard to market standards for your sector, for your asset class in a present moment where the tide is coming, the regulatory tide is coming. We've already seen quite a bit of momentum around, sustainable finance disclosures in the EU. We've seen some discussion at the SEC level. So I think the role for independent sponsors in particular is, Kevin mentioned around exerting influence and culture within a company. That can be done industry-wide. Companies within an individual sector can start to think about what are the measures that are relevant for us in the real estate space, and particularly within multifamily. Something that we've done is to participate and help to support our peers around a multifamily impact council, where it's really thinking about what are the specific metrics that fall broadly within ESG and social impact that are meaningful for our industry, that resonate with our stakeholders and investor community, and that we can agree upon so that we have some uniformity and can exert that influence. So I think it's really important to be thoughtful around the nuance that if you are an independent sponsor or GP where you are being selected by an LP, by an allocator, because of your core competency and expertise in a very particular area, we need that expertise and insight as a practitioner in the standards themselves. And by taking a leading role and start first with the commitment. I think everyone's at a different place in their journey, particularly if you're a smaller operator, starting with a commitment to establishing an ESG policy, starting a commitment to identify a roadmap or framework for your team. I thought the examples that Heidi gave were very pertinent and certainly resonate, where this is an additional lift for teams. And so being able to keep it top of mind and not siloed within that one ESG impact person, but where it really starts to infiltrate and integrate the workflow and the internal business cycle and discussion, that can be done in a variety of ways. Checklists are great. There are established frameworks in the marketplace. Certainly, we report to GRESB, which is a real estate specific ESG related benchmark. There's the SASB standards as well. There's also the broader frameworks like the UN Principles of Responsible Investing, which is really more of a framework of intent versus specific measures. And then also thinking about tools such as IRIS Plus through the Global Impact Investing Network, where you're selecting the measures that are most relevant for you and for your particular organization or constituents to drill down into the metrics that you can track over time. So I think it's really important to just identify the intent, a framework, and then start to drill down into those metrics. I do want to acknowledge that I think ultimately what we all want to get to is a verifiable set of information. The preference would be quantitative in many cases that indicates that a certain initiative has delivered a certain outcome that we're looking for, that's measurable. I think that getting to that place where we're all trying to get to, and really having that data-driven set of information. There are a number of tools that are improving that, particularly in the environmental space. On the social side, we need more. That's an area where certainly within the real estate space, it's more challenging because there is a certain bit of proliferation and trickle down, for lack of a better term, that is hard to quantify. But there are a number of resources available in the marketplace. And I just can't stress enough the importance of taking that leading role versus waiting for an implementation of regulation from outside to determine and potentially hamstring your ability to really respond to the marketplace in a really meaningful way.
Right, this is so helpful. And I think for our audience who still, looking for any resources, any tools, and where to look for more information. So this is very helpful. And before, I think we will leave some time for Q&A, but before we do so, I wanted to ask my last question on the benefits of ESG. So I think, Andre, you can really elaborate on that. You touched upon it before. How is the increased ESG focus can help improve the financial performance?
We're seeing in many respects, 12 to 15% increase in valuation of the buildings. Because you're lowering your utility costs and overall management costs. But with ESG, right, like, so, on new construction, we're looking at new building materials. We're looking at a wind solar combination that is 6 times greater than just solar alone. We're looking at, graphene additives. We're very excited about what graphene can add to both solar panels and a wide variety of like concrete as well. So in concrete, it can increase your tensile strength by 30%, which now reduces the amount of concrete used in your building. So you're reducing your overall cost and improving the quality of the building as well. So all of these, by using better building materials, by using ESG, like solar, geothermal, and some other properties, you're able to reduce the cost, and it makes the building more profitable and obviously more environmentally friendly.
I can add something else also in terms of financial performance. And as a GP, a private equity GP, we make a good part of our return on the exit. And what we're doing now, and I could give you a live example. So we have a company, it's in the packaging world. We have it in the market, and one of the things that we've done is we have 2 large manufacturing facilities. We have put solar panels on each of these facilities. So a good amount of the power that's needed to run manufacturing facilities, which is significant, as you all know, is powered by solar. And so we are actively referencing that in the marketing materials going out to market, that it has an ESG element to it. Besides some other things, we're in a zone, opportunity zone, and other things, right? So we're highlighting all of that because I think the type of buyers that are going to look at it now are more and more focused on ESG. And so if they could check that box, this is not only a good company, good financial performance, but it has these ESG elements. I think that today is going to differentiate you in the marketplace, and it'll help you with your exit. So I think that's part of the value creation chain that you have to identify as you exit.
Yeah, and I would say, just to add to that, certainly from the financing perspective, and this is real estate specific, but may not only be applicable there. In terms of securing financing, particularly in the debt markets, we're starting to see certain programs and products that are really driving towards ESG related initiatives, and where it's being inserted into the underwriting, and in some cases the actual cost of capital that's available to you. And so I think that's something to keep in mind. And I know Andre touched on this a bit as well, but when thinking about the exit and thinking about some of the incentives and initiatives where there is actually public-private partnership or subsidy, incentive, or otherwise that's layered into the actual asset because of an ESG related component, that ultimately may have value for a next buyer at exit. So that is something to keep in mind. And it also gives you an opportunity to think about how you might restructure a transaction if you're able to implement certain ESG related components, if there's a market for that, and if it actually does help improve the economics of the opportunity as well, if you make that commitment and insert those factors.
I would quickly say that it increases your buyer pool by implementing these ESG strategies into your buildings, right? Because a lot of groups won't even buy your property if, like, for instance, New York City is giving grades on energy efficiency, and if you have a D grade, an institutional client is not going to look to buy your property. So
great point, and thank you for sharing your thoughts. I'm going to check with Roger. Do we have any Q&A from the audience?
We have a couple of good questions here. One is a bit over my head, so I'll read it, and we'll field it and see what the thoughts are. One attendee asks, I haven't heard anyone mention the United Nations or Sustainable Development Goals / UN Environment Program, which essentially started ESG and sustainability. Can you share your views on whether any of the above impacts your business when you keep ESG in front of mind for your business?
I'm happy to jump in on that. And I was remiss in not mentioning it. I think that's a great point. The UN Sustainable Development Goals is very relevant. And in fact, a number of the ESG frameworks that were mentioned today, including the IRIS Plus and others, they actually roll up into the UN Sustainable Development Goals framework. Just to level set for anyone that isn't aware, the UN Sustainable Development Goals, I believe there are 17 of them. They're very broad categories around, around various components of environmental, social, and governance-related equity sort of categories, things like sustainable cities, wealth inequality, gender inequality, those types of concepts. And so with regard to our business, we actually use an ESG-related framework and look at ESG-related metrics and some of the reporting benchmarks that we use specifically tied to the SDGs. And we choose to select SDGs to focus on that generally cover the metrics that are most relevant for our business. So for example, when we're thinking about inequality within communities, there are very specific measures that actually tie to that particular sustainable development goal, whereas other groups may be looking at something different based on their needs. So I think that's an excellent point to raise. And certainly for any sponsors that are just getting started with what framework would work well, the SDG seems to be a universal language that resonates both with LPs and with other peers across sectors universally.
Great, and I would direct to Heidi. I think also, when you're tracking the performance and kind of trying to get to, to the level where you track the results, year over year, I'm sure you are incorporating SDGs based on, each portfolio company. Maybe you can elaborate on that as well.
Yes, it's certainly top of mind. As previously mentioned, our investors are actually very focused on that as well. We're in constant dialogue with them, and they perform kind of yearly check-ins and focus on a different topic every year, and this year it was climate change, or this past year in 2022 it was climate change, and a lot of focus around that and how we're thinking about it's one of the 17 goals, and just to increase awareness and focus around that. And whereas potentially right now people are not necessarily actively demanding that we report on that, it is coming. And so we, like everybody said before, we're all behind the 8 ball a little bit, because we know it's coming and we have to prepare for it. But so it's top of mind, and it's definitely one of the categories. All of the categories are important, but you, like Alicia said, you have to focus on the ones that are important for your business, and so each case is a little different.
And we have 2 more. Does the panel see more funds being raised that are solely focused or focused on ESG?
So I'm happy to jump in on this again. I think I'll answer this in a nuanced way. I think there is increasingly more appetite around investment opportunities that touch on ESG, and increasingly the desire to see that those opportunities have verifiable, measurable approaches to providing, that feedback loop. What I will say is that the number of funds that are explicitly marketed as ESG, that's something that's evolving. I think, as many folks here very likely have seen, ESG is very quickly becoming politicized, and that has implications with respect to certain types of risk that I think all capital providers care about, whether that's headline risk, regulatory risk, or otherwise. So I do think, to the question, I think it's a great question. I think there's significantly more investor appetite for access to these opportunities. We're seeing that a lot on the family office side, and it was mentioned earlier around wealth transfer. And, certainly anecdotally, I've seen where it's that one trustee from the next generation who's very eager to learn more about a very niche opportunity that's very much within the ESG space. But regarding branded ESG funds, I do think that continues to be an evolving movement where you start to see your peers in different forms, and you might be an ESG impact fund and they're not, but you're doing the same thing. So that's sort of my candid thoughts there.
Anybody else? Okay, so we have another question here. This one is pretty good. The panel has targeted and talked about some very large companies, GE and other large corporations, on what they're doing to kind of hit that net zero initiative. The question is, how can a small company like ours, the person who asked this question, integrate ESG into our core competencies? Maybe a couple of thoughts on that.
I mean, I think I touched on it, a bunch, by using 100% electrification of your buildings, by sealing your building envelope, by, that's more the environmental side. From the social side, and governance, governance obviously is complying with, say, local laws that are being enacted, like Local Law 97. But from a social side, making sure you're using local community members for the bill, gender equal pay, a diversity within your work pool. There's various ways that a small developer or investor, owner, operator can do the same as the larger corporations.
Well,
I think
go ahead, Doug.
I think the question is around resources, right? A large company perhaps has more resources to throw at ESG. I think as a independent sponsor, since that's the topic of this panel, as an independent sponsor, you need to pick your spots. I guess that's the best way I would frame it. You need to pick your spots and be thematic about it, right? And you don't have $1 billion to throw at climate change, but you can have themes that will impact it and impact your investment decisions and what you do with it. So I think you really need to pick your spots. That would be my answer.
And I don't know what type of business this person has, but just by sheer dint of asking the question, it's already in your mindset. You have an awareness around it. I think everyone has given some tactics. I don't think necessarily it's a one size fits all relative to your resources at bay. So obviously you have a smaller business. It is likely an exercise in prioritization, and what lens you want to bring to that prioritization. If it's value creation, which component of ESG is going to help you take share? If it's sustainability or social, take a hard look at your employee census and how do you measure? If it's governance, do you even have a board? So again, it's not a one size fits all solution, but kudos for even asking the question. So
yeah, I think I would just add to that, take stock and audit of what you may already be doing that falls within the ecosystem broadly. If you have DEI related efforts, or if you simply have a diverse workforce or are making inroads informally, you start to crystallize and formalize around broad themes, as was mentioned. And I think that that's a really great place for a small company to start, where the resources to allocate, whether that be to consultants or just time, which is among the most precious resource for many, being thoughtful around what are we already doing that fits within these categories, and we can start to really institutionalize that from a set of policies standpoint.